Good morning, everyone. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion. We're here for Jobs Day. Joining me today, we have Nick Colas, co-founder of Data Trek Research, as well as my colleague Allison Schrager, also a columnist with Bloomberg Opinion and a senior fellow at the Manhattan Institute. The story today is that non-farm payrolls, the expectation in the Bloomberg survey is that they increased a net of 175,000. That would be from a prior number of 256,000. In terms of the unemployment rate, the expectation is that it stayed steady at 4.1%. Some bigger picture here. After cooling earlier in the year, it sort of feels like the labor market is roughly stable for the moment, but that interpretation is always subject to change. This particular month could get kind of tricky, so we want to be very careful with the data here. First, January saw California tragically ravaged by wildfires. Secondly, this report will feature several big technical adjustments. In the household survey, it's going to reflect for the first time the Census Bureau's new population estimates. And then over in the establishment survey, that will be revised. Past data in the establishment survey will be revised to reflect the quarterly census of employment and wages. This is all pretty inside baseball stuff, but we do want to be aware of it so that we don't go down any bizarre rabbit holes here. Nick, let me turn it over to you. High level, what is your read of this labor market as we head into this January data point?
Yes, thanks. I mean, my read of the labor market in the US is that it continues to chug along in a pretty strong way, not so strong as to create a ton of inflation, not like it was in 21 and 22, but reasonably strong and strong enough to keep the unemployment rate low with some fairly modest job growth, call it 150 to 200,000 people a month. And that's the level you need in order to keep unemployment stable. Wage growth, which we'll also obviously touch on with this report, has been coming down, and that's good from the Fed's perspective, but it's still running a little bit hot relative to where we were before the pandemic. And overall, the economy is creating enough jobs so that people, generally speaking, have the ability to get reemployed if they are unemployed for any reason. And I just want to say, as we go through all these numbers today, let's keep in mind that everybody's situation is different. People might hear the jobs report and say, well, that's nonsense. I don't have a job and I want one. So individuals have very different experiences in the market. And we're just talking about the very highest level aggregate data that we'll see today.
Okay. And so you do call out average hourly earnings. Last month we saw them advance 3.9%. That's year on year. I take it maybe you're not much of a productivity bull. Is there any scenario in which you could get comfortable with a pace around 3.9%, Nick?
Productivity is such a choppy data series. And if you look at the data back to the 1940s, 1950s, it's very clear that we had some productivity booms in this country after World War II and again during the 1990s and early 2000s, but it really lagged the last 10 years. So productivity is one of those issues that I'll believe it when I see it for a year or two or three. And in the interim, and more importantly, Fed Chair Powell want to see wage growth between 3 and 3.5%, not between 3.5 and 4%, because the former is much more conducive to a lower inflation environment.
Okay. Allison, about a minute to go before the data prints here. From a Fed perspective, I call me out if you think this is not a fair summary, but I think in our discussions, you've become relatively convinced that inflation might be settling in a little bit on the high side, and that rates also may be higher for longer, as we say in the biz. Is there anything in the jobs data, either today or in the coming months, that could change your thesis on that?
Well, I mean, we'll see what the jobs number says, but I think Tom's largely right that this is like a healthy labor market. And it's hard to argue that, there's a restrictive element in the economy right now. I mean, it's a good unemployment rate. It's not a hot labor market, but it's hard to argue it's a bad one either.
Right. All right. Well, here we go. We've got about 15 seconds to go. We'll be looking closely at the reaction in bonds. Of course, yields have moved down fairly remarkably over recent weeks. So we'll check out if there's any action over there today. So here we have the numbers populating on the screen. So your change in non-farm payrolls comes in at 143,000. That's less than the survey was looking for of 175,000. Let me take you over to the unemployment rate. You actually see it move down to 4%. I think those ratios are going to be very, very important, especially, in a month where we do have a lot of funny business going on with the revisions and so forth. The ratios are one of the best sort of comprehensive looks at what's going on in the labor market. And again, you see unemployment actually stepping down from 4.1% to 4%. A few other things that are noteworthy here. Average hourly earnings, Nick called this out in the preview here. Month on month, you see this move up to 0.5%. This can always be compositional. It can depend on the types of jobs that are being added to the economy in any given month. So, you always want to take this with a grain of salt, but on a year over year basis, 4.1% is your change in average hourly earnings. Nick, I'll give you the first chance to weigh in here. What most jumps out at you, and what do you make of this average hourly earnings volatility here?
Yeah, just without having the benefit of looking at the whole release, it's a funny set of numbers because we came in below expectations on job growth, but we came in below expectations on unemployment rates, and we have wage growth that is substantially higher than I think people would have thought it would be. And that's odd to me, given like the JOLTS report for December seemed pretty benign in terms of the underlying fundamentals for the labor market. So to see wage growth up this much is a bit surprising. So I guess we'll get to the bond market response, but I don't know if this is bond bullish or bond bearish. I'm guessing bond bearish, but we'll see.
Yeah, one additional data point that I do want to call out is you get 2-month payroll revisions that are quite positive, 100,000 plus 100,000. So maybe on balance that helps us explain this kind of funny report where non-farm payrolls were for the month of January in particular not as strong as expected, but you at the same time you see sort of strength in average hourly earnings, strength in the unemployment rate. Allison, what are you making of this?
I don't know. It's pretty good. Like I thought the revisions were supposed to be to the downside. So but they're quite positive. I'm trying to see, and my eyes are failing me this early in the morning. What happened to the labor force participation rate there?
Yeah, let me.
That could tell us why the ratio, something about the ratios.
Right. So labor force participation does step up a little bit to 62.6% from 62.5%. And that is indeed above consensus as well. So not a huge move, but meaningful enough to move the needle, I think.
I would have thought it would have gone down, and that would explain why the why the unemployment rate went down. I mean, this is all, I think we're straining to look at the tea leaves here, but I think it just reiterates Nick's initial assessment that it's a pretty good labor market. There's some always irregularities this time of year, but as I said, a lot of seasonal workers, work. Maybe people are. I was going to say people leaving the labor force, but I guess not even joining. So I mean, wage growth is strong. So I think this looks at the very least, it doesn't suggest that the economy is slowing and needs more stimulus.
Yeah. Just for some additional context, I've put the yield on the 10-year Treasury note up on the screen. And I think you see some of us sort of scratching our heads in real time as to what to make of this. And I think there are a lot of people in the markets doing the exact same thing. You saw sort of the knee-jerk reaction to this number was a very, very temporary drop in yields as you saw the non-farm payroll number come in a bit soft for the month of January. But you now see the yield on the 10-year Treasury note up a bit on the day. We're looking at 4.47%, generally speaking, which is not a huge move, but we are up in a world in which we're seeing the unemployment rate fall and average hourly earnings looking fairly strong. Nick, that might be a good segue for us over to some of your thinking on the 10-year Treasury. You wrote about the 10-year Treasury in your phenomenal newsletter, daily newsletter earlier in the week. You wrote about both the Treasury note itself in some historic context and its implications for the equity market. Why don't you tell us a little bit about your thinking about what's going on in the 10-year and how that maybe dovetails with today's report?
Sure. Yeah, the bottom line is that the 10-year yield, the 10-year bond, has been the most important security in the world for asset allocation over the last year and probably longer, but the data really parses very finely over the last year. When 10-year yields rise, as they did for parts of last year, it's basically just the S&P that outperforms. And then when they fall, which was in Q3 of last year, everything else outperforms. So the 10-year has really driven the fundamental risk barometer of this market, global equity market, for the last year and change. And that's what makes it important from an investor standpoint. What makes it important from a policy standpoint is 5% is kind of this critical level. And it's there for a reason. Over the last 20 years, the 10 years rarely been above 5%, call it in a few months at the most. And it's always come down after that. The market doesn't want to see it break above 5% simply because we just don't know what happens to the economy if rates get that high. And just this week, Treasury Secretary Bessent was talking about this very phenomena and saying that's the number the White House is thinking most about because of its effects on the real economy, because of its effects on the capital markets. And so we don't want to see it go over 5%. And thankfully, we're well below that right now. And it looks like the market doesn't want to trudge its way higher again. But the minute we get close to 5%, the equity market and global currency markets begin to get very concerned.
Yeah. Allison, I'm not sure if you heard these comments from the Treasury Secretary, but Treasury Secretary Scott Bessent, as Nick alludes to, has sort of been doing a bit of a media tour this week, and one of the things folks have been drilling in on are these comments made by President Trump that he'd like to see lower rates. Bessent sort of comes in and he explains that sort of controversial comment away as no. President Trump is focused on the 10-year Treasury yield. He's not trying to tell the Fed what to do, but he would like to see lower 10-year Treasury yields. I guess is that something that a president can and should be trying to control? And B, is that good policy, do you think?
Well, it depends how you go about it. Obviously, I mean, I've always been obsessed with the 10-year, and I'm glad it's becoming a thing. I mean, I've always liked it just because I'm a macro finance economist, and I've always felt like longer term rates have more macro information in them. So I've always just found them inherently more interesting. We have longer data sets with them. And honestly, the president should care about it. It's a great barometer of the macro environment. So he should want, and lower rates sort of can signal a lot of very healthy things. He shouldn't be sort of dictating, what rates are, or, trying to sort of, I wouldn't be for more QE to bring it down. But if he is like, I want to lower 10 years because I want to get serious about deficits, or I want to get serious about productivity growth, and that will bring down the 10-year, then I'd be all for that. That's what we should want from our presidents.
Yeah, it is. It is an interesting framework because, of course, one of the big campaign themes was housing affordability, and honestly, probably the quickest way to more housing affordability is to create a set of policies that lead to lower 10-year yields and ultimately cheaper mortgages.
Well, again,
I've
that
put
how
up.
you do that, it, like, also matters. Like, are you going to do that by expanding whatever programs Fannie and Freddie are doing to make mortgage rates cheaper than they should be in an irrational market? Or are you trying to grow prosperity? And, so people can afford better housing and building better housing. I mean, you said, like, in principle, like, I don't have a problem with this. It just depends what the means are.
Sure, sure. Hey, real quick, I just want to. I've put up the decomposition of January's data here, and you can see it up on the screen. A few things that I want to call out real quickly to frame our discussion going forward. So again, 143,000 jobs added net to U.S. payrolls in the month of January. Where is that coming from? The strongest contributors, the biggest contributors, 38,000 from trade, transportation, and utilities. That is indeed a seasonally adjusted step down from the pace in December, but still a strong contribution. Financial activities, sort of nothing special doing, 7,000 jobs added. You do see we shed 11,000 11,000 jobs from payrolls and professional and business services. We also we continue to see quite a strong contribution from education and health services. This is one of these sort of acyclical areas that has been a big contributor over recent months and years, and so far we don't see strong evidence of a step down there. Leisure and hospitality, quite a weak January. Maybe that had to do with the weather in some way, shape, or form. Maybe it had to do tragically with the wildfires in California. Not clear, but maybe that helps explain some of the headline weakness here. And then 32,000 from government. I guess we'll see where that goes in the months and quarters ahead as this administration works through its policy of buyouts through the Doge administration. Okay. Let's go directly to policy, Allison. It's been kind of a crazy couple of weeks in policy. We've got the whole will he, won't he thing going on in tariff land. And with China, at least, it seems like he will. We've also got this government downsizing conversation underway. Do you have any idea how this pans out for the labor market in particular? I mean, a lot of people. Michael Sembalist over at J.P. Morgan has described this economic agenda as sort of alchemy. There are so many different moving parts, and I wonder how you're reading the alchemy.
I think that's a good way to do it because you don't know how. On the one hand, government jobs has been a big source of the labor market and a big source of growth. I mean, largely at the state and local level, which I'm not sure there's a lot of movement happening there, but at least at the federal level, if all these buyouts stick, I said we could see a decline of jobs in the government sector at least at the federal level. So that would be something. On the other hand, if the deregulation goes well, we could see more growth in the private sector. So I guess that would be a form of alchemy of moving people from the government sector to the private sector, where theoretically they're going to be more productive. So maybe that will work. Of course, I said it's tricky. You have to have everything, line up just so. So again, there is certainly uncertainty around sort of tariffs, around, I guess we have more details now on tax policy, which, is sort of definitely also a mixed bag of things that are pro-growth, definitely adding to the deficit, and other things that, well, one thing we're getting rid of carried interest, simplifies the tax code. I don't know if that really is going to make a big difference. It'll make a big difference to portfolio managers. So it will be interesting, but potentially, yeah, it would be fun to see, or not fun, interesting. As an economist, it'll be fun to see shifts in the labor market and away from government and into the private sector, and see, one, if that has happened. Two, is it the more productive members of government who have options in the private sector that do this? And two, does that really have an impact on productivity and growth?
Yeah. Nick, are you having as much fun with this policy agenda as Allison is?
I doubt that. She seems to very, very much enjoy it, and that's wonderful and lovely. I just keep thinking about what Chair Powell must be thinking about, because he sees the alchemy and he thinks, God, I've got to deal with all this at the other end of the train tracks. And that's going to be very difficult, because the push and pull of all these different policies and the net effect on the economy are essentially impossible to predict. Plus the fact that when you get these many moving parts moving in their own independent ways, you increase the chance for something to fall off the rails to begin with. So you increase some tail risk as well. So to me, the bottom line is this just makes for a lot of very convoluted Fed press conferences for the rest of the year, because there's going to be so many different issues to talk about, and no one's going to really know the net effect on the economy until most likely well into 2026. But by then, it's too late to set policy around the outcome.
I'd say possibly we might not know till like 2040, because these could be big structural impacts that take years to understand.
Yeah. One of the ways I've started to think about it is, obviously we don't know where the Fed is going. We don't ultimately even know where the Fed is going later in 2025. But what's happening here and the uncertainty that tariffs and other policies introduce do seem to sort of take quote unquote soft landing cuts off the table for the foreseeable future. Do you agree with that framing, Nick?
Yes, I do. That's a very sensible way to put it. The economy is not on autopilot. No part of this economy is on autopilot right now. So the Fed can't sort of take its hands off the wheel and just say, okay, one in June, one in December, have a nice year. We'll see you in 26. They've got to actually pay attention every quarter.
Yeah. All right, well, so let's go a little bit to risk management. Nick, I was talking about your newsletter earlier. One of my favorite features of your newsletter is you've spent decades in the investment business. You've seen it from a lot of different places, and you do this thing called Storytime Thursday, where you sort of share anecdotes from your past on the street and on the buy side and so forth. And so in the latest Storytime Thursday, you revisit 4 episodes of extreme market uncertainty. And so, naturally, as we're talking about, a lot of people think we're in another very uncertain time for equity markets in particular. It's not just the policy stuff. It's the fact that we're coming off these 2 extraordinary years. It's the fact that we have this very interesting AI narrative, which might be absolutely awesome, but it might also introduce the possibility that we get asset bubbles developing in certain parts of the markets. And so I wonder if you could tell us a little bit about your Storytime Thursday and put it in the context of the risk that we're facing today.
Yeah, Storytime Thursday started as something that I thought would be easy to write after a long week of writing, and it ended up being by far the most onerous piece that I do during the week, because it is telling my story. It is telling my story of 30 plus years on Wall Street, and doing that efficiently can be hard. As far as what the message from that piece was, the irony of this market is we all think it's so uncertain. We all think these manifold issues are going to come up and bite us, but the VIX is 15. And that's a very typical bull market level for the VIX. The implied volatility of this market is extremely low, and the apprehension from investors is extremely high. And that's odd to me, because ultimately, as a trader or investor, you got to respect the tape. And the tape is saying we are in a low volatility environment. We're in a bull market environment. Nothing fundamentally bad is going to happen. And that's very much unlike, obviously, the times that I chronicle in that piece, the 87 crash, 1990s recession, and then the whole .com bubble bursting and 9/11 and the rush to Gulf War II and then the financial crisis, all of these different periods, high volatility, high uncertainty. Now we have this narrative of high volatility or high uncertainty, but the market is saying, meh, it's not that bad. The VIX is 15, implied vol is quite low. So that to me is the central irony in this market right now.
Yeah. The big question here is, again, if you're concerned about this environment, what do you do about it? And it does sort of feel like there are no easy answers. One of the things that you sort of imply in your newsletter this week is it might be an opportunity for some protective puts, right? The issue with protective puts, famously though, is that they are great at protecting you against crashes that happen very quickly. But if it's a slow moving bear market, something like the .com bubble bursting, they actually aren't very helpful at all, right? Because
well, they are in the current situation because implied volatility is quite low. The VIX at 15 trails through the entire option chain, and so you can buy it down 17% downside protection in the S&P for about 1.5% of the portfolio value. So that's not very high. And so if and let's face it, markets don't grind lower when they're in a bear market, they puke. 2022 had two massive downdrafts and a couple of things in between. 2001, 2002, very high volatility markets. So when we see a bear market, volatility always goes up because correlations go up. And so a put strategy will protect you because we're not going to grind our way lower and be down 20% in 2025. We're not going to be down, 0.2% a day. We're going to be down 2 and 3% a day. That's the way bear markets always work.
Right. Allison, I wonder how you're thinking about risk mitigation right now, because it is it's a very tricky environment. Classically, what do you do if you're nervous? You sort of add treasuries to your portfolio. You move out of equities, but in an environment in which one of the biggest risks is tariffs or what's seen as inflationary policy potentially, maybe that's not as obvious of a move. Other people think of gold, precious metals as a part of a risk mitigation strategy, but man, gold almost seems like a meme over the past year. Some people might be looking at the price of gold and think, there couldn't be a worse time to enter that position. So I wonder how you think about risk mitigation in 2025 for people that are nervous.
Well, I think Nick brings up a good point of the risk environment we're going in is bigger than Trump. It really is. We're entering a new phase of potentially industrialization or a new sort of tech revolution. And that is just, and not only that, we're doing that with very concentrated markets. So that's just going to mean more risk. And for like maybe a decade or more. So I think when you're facing that environment, what you got to do is sort of check in with your fundamentals and not try to time it. Gold, I've never been a big believer. It's a big risk hedge in any way. It's more volatile than stocks. So why would you go into something more volatile than what you're trying to hedge? That's never really made a lot of sense to me. I think, again, you want to think about what your long-term goals are. And, fixed income might be, as I said, is a good hedge. If it said, make sure you duration match appropriately. That way changes in bond prices don't hurt you as much. And the other thing you want to think about, and this is really unpopular, is diversification. Now, that sounds like kind of wild right now because, anyway, the US outlook looks kind of hairy with volatility. At least we're growing. And international diversification doesn't look super compelling at the moment. Europe's growth prospects aren't great. There's more uncertainty in Asia. But on the other hand, again, the principles are diversification does give you greater return for lower risk. And, you never know what's going to happen. So, what I'm doing, although my portfolio isn't looking great for it, is, as I said, checking in with, what I believe is true about markets, which is, hedging with fixed income and thinking carefully about duration, and also diversification and holding fast on international diversification anyway. It doesn't seem like in the short term it's going to be the best thing.
All right, fair enough. What here's a last question for both of you. What is the next thing to look for? There's so much going on at the policy level. It's hard to know where to focus. As Allison called out, beyond tariffs, it seems like the next thing to look for might be further details on tax policy. We've got a big inflation report coming up next week. Nick, what is going to be the next key development for you that's going to give you some clarity on the outlook?
For me, it's inflation. It's inflation, and it's housing inflation in particular. It's a big component of CPI, a bigger component of core CPI. And to me, Powell put his, stake in the ground on housing inflation declining to keep overall inflation declining. And that's kind of the central keystone of his argument for lower rates this year, is that OER goes down, shelter goes down, therefore CPI goes down, therefore the Fed can cut rates. So to me, the linchpin of the whole argument comes down to housing inflation.
Okay. Allison, what about you?
Again, inflation, because I think that will tell us, one, what the path of the 10-year is going to look like, certainly for the next year. And also, is the Fed really having to sort of have room to cut, or sort of just come to terms of staying, rates where they are? So I think it's really going to tell us a lot. And I think also about the health of the macroeconomy.
All right. Well, with that, thank you to everybody for tuning in. Thank you to Nick Colas. Thank you to Allison Schrager. And we'll be back on February 12th to talk about CPI. Take care, everyone. Have a nice day.